Do you ever feel like missing out on all these great trading opportunities? Well, probably because you've clicked on this video. You see Bitcoin or all these cryptos pumping and you're like, okay, I need to get into this game. I'm missing all these opportunities. So you saw this video and it also has a nice clickbait title and you thought to yourself, let's click this video. I need this strategy. It might work for me. But that's just to hook you in this video. It's not gonna be that easy. This is not gonna be your average trading video. Of course, why? Because there is no magic pill strategy. There is no magic strategy that just has a 100% win rate. There is no way that you can win 100% of the time. So this is gonna be a very different trading video. I tricked you into clicking on this video, but this is gonna help you in the long run. I'm gonna give you the tools that you need to create your own trading strategy. I'm gonna give you everything that you can use. Of course, I cannot explain everything in depth, but I can give you the tools. And if you do some proper research on YouTube, or if you watch the upcoming videos on my channel, you'll probably learn a lot and you can build your own trading strategy. But most of you already bought some courses, watched some YouTube content or whatever, and you already know some things and you can puzzle them together with my tools that I will give you. So without further ado, let's dive in and discover all these best kept trading secrets. Just kidding. I'm just gonna give you these wonderful tools. So pay attention and let's design your winning trading plan for you in this video. All right, so we have 4 fundamental pillars that I'd like to discuss in this video. What makes a great trading strategy? So point 1 is of course the technical analysis of a trading strategy. So at this point, you will have to decide which kind of strategy will I be trading. So for me, I'm trading a combination with smart money concepts, price action, some ICT parts, and that is what is working for me. But in the end, what is working for me might not be working for you. So at this point, you'll have to discover what will be the way you want to trade. Do you want to really understand what this price is doing so you can go more into price action? Or do you really want to go in depth and really want to understand how the orders are flowing in the market? Of course, there's a lot of videos about order flow, but you can also go very deep and have some extra programs where you really dive into order flow. But of course, that's not my kind of style of trading, but you can go really deep and really understand how liquidity is working in the market. So if these are the things you want to trade, you'll have to probably look into ICT, smart money concepts, price action, order flow trading. These are the things you want to research. But then there's some people who don't have a lot of time. So if you don't have a lot of time, you're going to be a swing trader and you're probably not looking at every order coming in and out of the market. So if you're a swing trader, you're probably going to be trading ranges, range high, range low. You're just going to take a position after some kind of confirmations, or you can just trade some patterns, some continuations in the market. That's something that would work well for a trader that really doesn't have a lot of time. But for me, when I'm trading, my core fundamental, when I decided to go one way with my technical analysis, it is understanding the market. Why was this so important for me? Because understanding the market gives me confidence into executing. If I don't understand what I'm trading, then I'm just pressing buttons, then I'm just gambling in my opinion. So I really want to understand what is happening. It really needs to give me confidence. Of course, if you're trading other concepts like patterns or trend lines or whatever, it doesn't give me a lot of confidence. These are very basic concepts and a lot of experienced traders will tell you that these are basic concepts. So for me, the decision was easy to make, but for you, it can be different. Do you want to be a range trader? There's a lot of great range traders in crypto, for example. In forex, I haven't met a lot of great range traders, but in forex, there's a lot of ways. Please do understand that forex has a lot of volume. There's a lot of manipulation going on, a lot of liquidity being used against you, and you might have already been liquidity. But the same goes for crypto. You might become exit liquidity, or you might actually enter after a huge liquidity spike and have a very nice position running. So these concepts are crucial to me to understand when I'm trading. But of course, it's all up to you. Do you really want to go in depth, make a full-time career in your trading, or do you really just want to be a swing trader, have a little bit of extra knowledge of the market and make some good investments? It all depends on what kind of trader you will be. If you're a swing or a position trader over the long term, you probably don't need to understand all these manipulations because you have a lot of room for error. Because let's say you wanted to buy Ethereum a month ago or even now, or Bitcoin, well, you can just decide, okay, we are at a resistance or a all-time high. It's at an all-time high when I'm recording this video, so no idea when you watch this where it will be, but you can make a decision. Okay, we're at an all-time high, we have resistance, for example, we are rejecting that level, we are consolidating at that level, so this might be a confirmation for me that we are going back to the downside, so I'll take a short position. So this could be for an investor who says, I've already been holding Bitcoin, now I can just sell my Bitcoin. So it all depends on what style you want to trade. So for the technical analysis, please do your research, understand what it is you really want to trade. Do you want to understand and gain more confidence in understanding the markets, or do you just want a very simple, not time-consuming way of analyzing the markets and just swing trading or investing in the markets? So I think if you are a active day trader and you want to become a funded trader, you want to become a full-time trader, I think it is in your best interest to look into more in-depth concepts than just taking a continuation or a pattern trading strategy. But of course, it is all up to you. So moving on with the next pillar, of course, it has to be risk management. It doesn't matter which strategy you trade, what kind of trader you will be. Will you be a day trader or will you be an investor or a swing trader? Risk management is going to be crucial because if you want to sustain long-term profitability, you will have to have proper risk management. So let's dive right in. Let's give you a simple example of a lot of people who invest into crypto and they don't have risk management, and you probably are one of them, or you know some people who've done this. So let's say 3-4 years ago you bought Bitcoin at 65k or whatever, and you had no risk management. Of course now it's starting to pay, but only very small because we're at the all-time highs again, which is around 70k. So what happened? You bought it 3 years ago, you bought it at 65k or 60k or whatever, and you don't have any risk management. So you decide to hold it and don't sell it unless you're in profit. So what happens? For the last 3 years, 4 years, Bitcoin from the point where you bought went down and you didn't have any risk management. So you see it going down minus 10%, minus 20%, minus 40%, minus 50%, and there is nothing you basically can do because you don't have any risk management. So the first step into this, well, if you're an investor, you could be okay with these risk profiles, but even though if you're a quite decent investor, you're not willing to see your investment drop 40 to 50%. It all depends, of course, on your risk profile, because I know some people that choose 10 projects and just wait for one project to actually skyrocket. So it also depends on what kind of risk profile are you deciding on. But it's important to, if you take a position in the market, that you define your risk. Am I willing to lose 1%? Am I willing to lose 5%? Or you can even put a amount of money attached to the risk. Am I willing to lose 1,000 euros? Am I willing to lose 5,000 euros, for example? So it depends on what your own risk profile is. So if we are defining risk management, it all starts but finding out where are you comfortable. If you lose 1%, do you have emotions? Are you still stable? Are you able to stay focused and still do your thing as a trader or investor? If you are losing money and you're having emotions or you're feeling bad, then you're over risking. So that's already step one. Decide how much do you want to lose? What is my risk tolerance? How much am I willing to lose on that position if I'm wrong? Always take that in consideration. Even in these times, everything is going up, Bitcoin is going up, everything's green, it's very easy to make some money. But what will happen if everything is going down? It's not always going to go up, so you have to be aware. Even in those times where everything is going up and it's very easy to make money, you have to still remember and decide, okay, if this goes bad, for example, I'm in a short position right now, it's right in front of me on the screen. if it goes bad, I know exactly how much money I will lose on that position, or how much percent of my capital I will lose. And it's very important to know that, because if I'm anticipating how much I will lose, I will have less emotions, because I already know if it goes bad, if it goes south, I already know what I'm gonna lose. So that's quite important in defining your risk management. Now, of course, that is for investors or swing traders, for example. Of course, if you don't want to do that, it's up to you, but it's important, I think, for every investor to define your risk, even if that risk is losing 9 positions and waiting for that one miracle project that you are investing in. That's also defining your risk. There's no great investor who hasn't defined his risk. So moving on, we have the importance of a stop loss order. So very important. If you don't know what a stop loss order is, you have a lot of studying to do, but basically putting a stop loss order in the market is going to be a limit in the market. If price goes to that limit, that your order will automatically be cancelled at a loss. So it can be when you're shorting or when you're going long. So let's say, for example, I have bought Bitcoin at this point and it's running around 69k, but let's say I bought it right now, but if it drops back to 65k, then I'm gonna take my loss. And I want to define, of course, how much I'm gonna lose when it goes to 65k, but that's quite important. Definitely, if you're going to the more active style of trading, which is day trading, you want to have a stop loss order. This is something that is quite important, and there's a lot of thought that goes into putting a right stop loss order. So depending on which style of trading you decided on earlier, it's going to be important to find out where you will have to put your stop loss. So for most people, and this is the starting point of their career, they will just say, okay, I am willing to risk 1%. Okay, let's look at the chart. Okay, if Bitcoin drops 1%, okay, there I'm gonna take my loss. Now, of course, if you are trading with futures or if you are trading with leverage, then of course you'll have to calculate at which point, because if you're going a 10x or 20x leverage into a trade, into a futures trade, of course you will not have that much room, because if Bitcoin only drops 0.5 or 0.1%, you might already be liquidated. So there goes a lot more into risk management than just these basic principles, but understand you will have to define, depending on your strategy, where you will put your stop loss. So let's say you are trading, I'm going to give you a very simple example. If you are trading ranges, so we have a range high, a range low. Let's say you are buying at the range low. So Bitcoin is, for example, at 40k. I'm not sure if that's a range low or whatever, but let's say you're buying there. Of course, you want to determine where the range low exactly is. So let's say 39.5 is the range low. So you want to put your stop loss just underneath that range low. Very easily. If you do so, then if the trade moves against you and it breaks that range low, then of course you're gonna take your loss. You don't want the price to drop even further. And even better is when we have a crash in the market. Before the crash happens, or when it's happening, you will already be out of position. People that have not used the stop loss will have to sit out that crash or will have a very large loss on their account. So very crucial to use a stop loss. Second part is very important, that you decide, where do I put my stop loss? And the psychological way of thinking about it is, at which point am I actually wrong? And that's exactly the point where you put your stop loss. Of course, if you're trading smart money concepts, if you are day trading, there's another level to it. You can decide, okay, so we know liquidity sweeps, we know manipulation. So which low, which point in the market can still be liquidated, can still be a sweep. So I'm going to put my stop loss a bit more underneath it, so I can still take that little sweep if it happens. So that's more advanced, but it could be, if you're trading smart money concepts, ICT, price action, that you will have to decide on, taking all these technical parts into your stop loss placement. But very basic, at which point am I wrong? And at that point, you exactly have to put your stop loss. So I've talked about it earlier, but as well, we need to focus on implementing correct position sizing. If you're using leverage trading, if you're using, for example, in crypto, if you're using a 10x, a 20x, or 50x, you will not have a lot of margin before you get liquidated. So important to take note of that as well. If you're trading, what is my balance? How much am I willing to risk? How much margin do I have before I get liquidated or before I get a margin call? So very important as well to research that and always use correct proper position sizing for your entries. For example, in forex you will have your lot size, and let's say a normal lot size is 2 lots or 3 lots for you. Of course, it's important to decide which account balance you have, how much am I willing to risk, which pair am I trading, and decide how many lots you can trade to only risk 1% or 2% or 3%. So very important as well. Now let's finish this pillar with a very important disclaimer. When you are implementing, or disclaimer, it's an extra bonus tool that you can use, or psychological tool. When implementing risk management, it's very easy to decide on whatever rules you will use, but the hardest part is of course going to be the psychological level to it, because most traders will fail in their trading journey because of this risk management that is constantly failing. What do I mean? I mean over trading, over risking, just over leveraging their accounts, and that will be most of the times their biggest mistake in trading. For example, when they don't have diversification, let's say you have €5 or $5 pairs and you are trading them all together. Of course, you can have your position size correct and your risk parameters correct on every setup, but the correlation is going to be the same. So if the dollar moves against you, you will lose 5 times. So actually you're not losing 1%, but you're losing 5%. So it's important to also look at correlations in the market and diversify. You cannot just trade, let's say you're trading gold and you're trading the dollar. Well, it's basically the same thing because they are correlated. If the DXY or the dollar is going up, of course gold is going down. It's not always going to be like that, but there is a strong correlation. So let's say if Bitcoin is going up, of course the whole market is gonna somehow follow. Some coins more, some coins less. But very important to understand these correlations and to not bet on the same horse 5, 6, 7 times in a row, and in doing so risking more. And I've noticed a lot of traders, great traders that actually know how to trade, and they've come into a call with me and they said, I've traded the pound against the yen, I've traded the euro against the yen, and I traded the dollar against the yen. Well, okay, you've traded 3 different currencies, but all of them were against the yen. So if the yen doesn't make the move that you were anticipating, of course the yen has been bearish for mostly forever, but a lot of times the yen has been bearish. So if the yen, as it has done last week, finally decides to make a bullish move, or there's some fundamental things changing, you're gonna be I'm not gonna say it in French, but you're not gonna like the result because all your trades are gonna be, you know what I mean. So very important to take in consideration the correlation between all these pairs and make sure that you are risking the correct position size per position, but also over all your trades, over all your positions. So if you're an investor, the same goes for, you're not going to invest into 10 AI companies. No, you'll decide, okay, these 2 companies maybe, or this 1 company I will select. And let's say you want to risk €1,000 per trade. If you do want to trade all these tech companies, you can do so, but then you'll have to divide the risk per company that you want to invest in, if you don't want to miss out, and if there's different companies and you don't know, because I know a lot of investors do it like this, but in forex it's different. But you can do it the same. If you want to trade 2 dollar pairs, instead of taking 1% risk on each dollar pair, just divide your risk by 2 and just trade them if you want to trade them together as well. But most of the time it's the same bias, so I would suggest to you to choose the more high probability setup. Of course, you cannot always know this in advance, but it's a great rule to live by. And last but not least, please stay disciplined. It's very important. If you have defined everything correctly, you have position sizing correctly, you're not over leveraging, you're not over trading, please stay disciplined and follow these rules. But this is going to be the hardest part, because sometimes there's going to be a trade or a crypto and you're like, this is the best point, this is so clean, but it doesn't matter, because also those very clean setups will be able to lose money. It is often the most ugliest trade that can make you the most money. And remember, that being disciplined in risk management is going to be crucial and is going to help you succeed over the long term. Then we are moving on to the third pillar, and this is going to be a small one, but a very important one. This is going to be determining everything in your trading plan. And if you haven't thought about this, it is time. When am I executing my trades? What is the timing? What is the timeline when I execute trades? So very easily, what is the difference between an investor and an active day trader? It's timing. The investor will just buy it and say, okay, I'm just gonna hold it. It can go even lower. What does a trader do? It's gonna wait till it's almost at its lowest point. It's even gonna wait till it reverses and gives more confirmations, and then it's gonna take a position. So that's the huge difference. Of course, it has its benefits because you will not be in large drawdown, but it can also be negative because sometimes you will not get an opportunity because you have decided to choose a technical trading style, and sometimes you might not get an entry for your technical way of looking at the market. So it has its pros, it has its cons, but it's very important that you understand in creating this strategy for your own that timing in the markets is important. So when are you actually going to execute? When will you put your limit? When will you remove your limit? When will you put a trailing stop loss? Also, this could have been added with risk management, but these are important things. So when am I gonna actually put my limit? When am I gonna take a market execution? Will I put a market execution after heavy news like an NFP, FOMC, CPY, whatever? What am I going to do with my timeline? So even in your routine, when will I make my setups? When will I check the market? When is this setup ready to shoot? And this is something very important that traders forget. So for me, I have my targets. I see all my technicals on the lower time frame. I want to execute, and I'm waiting for my last confirmation. What are your last confirmations? So first you have your fundamentals, your technicals, everything is aligned. Everything is perfect till the lower time frames. What are the last confirmations you want to see until you pull the trigger? So very important and a very small concept of your trading strategy that is going to make your strategy the best. Do you want to wait for manipulation? Do you want to wait for a change of character? Do you want to wait for some kind of pattern? Do you want to see some special magic price action at the range high or range low? Do you want to see rejections? All these things are going to be important for your timing. Of course, you can go very in depth here, but I think this is very important that you define for your own trading strategy. When am I going to enter? Am I going to wait for this? Am I going to wait for that? Which confirmation do I first want to see before I enter? And understanding this is going to help you pull the trigger. So when am I going to pull the trigger? If not everything has to be perfect, but for some people it has to be perfect and everything has to be aligned. But decide in your trading strategy, okay, not everything has to be perfect, but I need these core principles for me to pull the trigger. And then moving on to the last part, I hope you enjoyed the video so far. So please give me a like, subscribe if you want to see more content in the future, because this last part is gonna be more important than all the other three. Now, let's start by giving you a quote. I went to a trading event from Tom Haugaard a couple of weeks ago, and it was a very beautiful saying. I'm not sure who said it again, but he said, or it was a question, how come trading is 80% mindset, but we focus 100% of the time on reading the charts on TradingView? So it's a very interesting quote. So of course, my last, and probably you'll need to think about it for a second, but my last part of this video is going to be market psychology, because I think not a lot of traders have psychology in their trading plan or in their trading routine, and it's quite important to have a good market psychology. You can have a great understanding of how the technicals work, but understanding where people are buying, where people are selling, how the markets work is quite important. But then as well, your own psychology in the market is going to be important as well. How are you dealing with losses? How are you dealing with setting expectations, with goal setting? How are you managing your emotions? All that stuff is going to be important. For example, we have fear in the market when it's going down, but also we are greedy when the markets are going up. So knowing how to handle with that and actually going against our natural monkey brain. And when the markets are going down, of course, you're not going to try to catch a falling knife, but when the markets are going down, you truly want to be looking for opportunities. How can we long the market? Now, of course, if the market's going very impulsively to the downside, you can also still look for opportunities to the downside. But it's removing fear, removing greed to execute in those scenarios. For example, I've heard a nice quote as well. Some people always say, buy low, sell high. But I'm not sure who said it. He said, I'm a fan of buying high and selling higher. It doesn't matter that we are very high or very low up in the market. Well, it does matter, but it doesn't mean that there's no opportunities left. If the market is dropping very impulsively, most traders will try to catch the bottom and you're going to be liquidated. So it's very important to have a great mindset, have a strong psychology, know how to manage your emotions. So I don't want to make it any longer by explaining everything about how to manage emotions, how to manage fear and greed. Of course, these are things that you really need to do your own research on. I gave you a lot of tools in this video that you actually can use in building your own perfect strategy. Of course, this is not a technical video, and be aware, I'm gonna make a lot more technical videos in the future, but of course this is one to start it all off. So if you like this video, please give me a like again, and let's summarize again what I talked about. So first off, the most important one is deciding on what kind of technical style you will be trading. Decide which is fitting for your own personality. Do you want to be an active day trader? Do you want to be a swing trader? What kind of trader do you want to be? How do you want to define your own trading strategy? Now, moving on, it was risk management. So defining your risk, being disciplined with risk is going to be crucial if you want to succeed in the long term. And then the third pillar was a very small one. It was about, again, timing and learning when you get the right confirmations, when you have to enter the market. And then the last one is going to be mindset. I haven't focused a lot on the mindset part because there's a lot of great tools online. There's a lot of podcasts, there's a lot of books that you can read about mindset. But of course, there's going to be a lot more videos where I'll go more in depth about mindset and all these tools that you can use. So please leave a like, subscribe, and I'll see you in the next video. Stay profitable.